Every family has one relative whose certain property is the only real way to build wealth, and one mate who swears shares are the only way that isn't a trap. It comes up at every barbecue, every Christmas, every group chat, and almost nobody in the argument has ever actually run the full numbers on both sides. Quick note before we go further. This is general information to help you understand how these two options actually compare, not personal financial advice. It's not telling you to buy a property or to put everything in shares. What it is doing is adding back every cost most comparisons quietly leave out: stamp duty, council rates, insurance, agent fees, the lot. Because both camps in this argument usually skip the boring parts, and the boring parts are where the real answer is hiding. This isn't a property bad video, and it isn't a shares are always better video either. Both sides of this argument tend to compare the good version of their own asset to the worst version of the other one. Property people quote the suburb that tripled in value and forget to mention the loan, the rates, and the agent who took a cut on the way out. Shares people quote the compounding chart and forget that most people who buy an investment property are borrowing money the bank would never lend them to buy shares with. So here's the plan. One starting amount of money, split two ways, every single cost included on both sides, 10 years later, no cherry picking. Let's meet the two people running this experiment. Jess and Dave are both 32, both already have somewhere to live, and both just found themselves with $150,000 they want to put to work. This isn't a first home story. They've already sorted that part. This is purely, where does the money go? Dave puts his $150,000 straight into a low-cost, diversified exchange-traded fund and does essentially nothing else for 10 years. Jess uses her $150,000 as the deposit and buying costs on a $600,000 investment unit, 20% down, plus roughly $24,000 in stamp duty, plus a few thousand in legal and building checks. She takes out a mortgage for the remaining $480,000 at a bit over 6%, currently a fairly typical investor rate. Here's where most comparisons stop and where this one keeps going. Jess's unit rents for about $460 a week, a bit over $24,000 a year. Sounds like the loan pays itself, right? Now add everything else. Property management fees eat close to $2,000 a year. Council and water rates, another $2,500. Landlord insurance, $1,500. Strata fees on the unit, $3,500. Maintenance, budgeting the standard rule of thumb of about 1% of the property's value, another $6,000. A couple of weeks a year sitting vacant between tenants, call it $900. Add the mortgage interest on top of all of that, and Jess's actual annual outgoings land somewhere around $46,000 against rent of $24,000. That's a shortfall of roughly $22,000 a year before the tax office gives some of it back through negative gearing. After that refund, Jess is still funding about $15,000 a year out of her own pocket every single year for 10 years. That's real money nobody puts in the thumbnail. Dave's side is almost boring by comparison, which is sort of the point. His ETFs management fee is a fraction of a percent. There's no property manager, no strata, no tenant, no phone call about a broken hot water system. He also gets franking credits along the way, a refund of tax the company already paid, which quietly boosts his real return. When either of them eventually sells, they both pay the same 50% capital gains discount, since neither of these is the home they live in. Run both forward 10 years on stated planning assumptions of 6% yearly growth for the property and 8.5% for the shares. Jess's unit is worth around $1,074,000. After paying off the loan, selling costs, and capital gains tax, her actual net result is roughly $500,000. But remember, that's not just her original $150,000. Counting the $15,000 a year she fed the property, she's actually put in around $300,000 of her own money to get there. Dave, who never added another dollar after his initial $150,000, ends up with roughly $309,000, fully liquid, sellable any day of the week. On raw dollars, Jess's number is bigger, but she got there by being forced to save an extra $15,000 a year. Whether she felt like it or not, the mortgage doesn't care about her motivation. And here's the twist that actually matters. If Dave had taken that same $15,000 a year and added it to his ETF, instead of just letting his original amount sit there, he'd finish with somewhere around $520,000, slightly ahead of Jess, with none of the tenants, none of the debt, and the ability to sell $10 of it on a bad week instead of none of it. This result isn't a law of nature. Change the growth rate a point in either direction, change the interest rate, change the state and its stamp duty, and the numbers move again, sometimes by a lot. The property side wins more often when growth is strong and borrowing is cheap, because leverage cuts both ways. The real lesson isn't shares beat property, or property beats shares. It's that the asset barely matters compared to whether you actually keep putting money in on purpose, year after year, regardless of which box it's sitting in. So next time that argument starts at the barbecue, you don't need a side. You need the question nobody in the argument ever asks out loud. For this specific option, in this specific state, with these specific numbers, what's the full cost, not just the headline growth? Pull up a stamp duty calculator for your state or a brokerage's fee page and actually do the sum for your own situation instead of borrowing someone else's certainty. Your one step tonight isn't picking a side. It's writing down, for whichever option you're leaning toward, the full list of costs this video just ran, and checking whether you're still as confident once they're all sitting on the page. Make sure you subscribe, and let's get sorted.